So good morning once again, and thank you all for being here today. I will present and defend my dissertation with the subject active portfolio management versus indexation, a study of correlation linked to a pandemic scenario. I've split my presentation into the following chapters, starting with a brief introduction, looking at the subject, then following with a glance at the mutual funds industry in Portugal, then presenting the methodology chosen, as well as the data and the results, and finally the conclusions for this research. I would like to start by briefly introducing the subject, which will also justify the periods taken into account for this research. The debate that actively managed funds can outperform their passive peers or their benchmark has been quite popular amongst the finance circles for quite a while now. And although this was perhaps the preferred choice during the dawn of mutual funds, in more recent years, we've seen a turnaround on the investors' side. Actively managed funds, of course, require a portfolio manager, professional portfolio manager, who seeks opportunities, taking advantage of fluctuations and individually picking each asset or each stock on their portfolio. All of this is in exchange for a fee, of course. This is in search of outperforming the market, and this is most noticeable during the bear markets, when the economic situation is the most volatile and arbitrage positions present themselves. Hence, the interest of selecting the COVID pandemic period to compare the results between the two. On the other side, we have the index funds or passively managed funds, which replicate their benchmark composition, and these are known to perform more consistently, providing a steady inflow of returns for the investor, but more importantly, with very low fees. During this research, I have selected several Portuguese equity funds and compared their performance in comparison with the chosen index through several metrics, with the purpose of really understanding if actively managed funds are getting less and less advantageous during unstable markets in light of the heavy management fees they charge. Looking at the split between investor types, not only most of the mutual funds shares are owned by individual investors, but there's also a clear increase of subscriptions throughout this period, which reinforces the idea then again that mutual funds are becoming more popular amongst small investors. On another note, there's a clear preference for real estate and debt funds, as we can see, which are generally less risky in the long term, as opposed to equity-only funds, and especially in the Portuguese real estate market. Moving on to the methodology. After performing a thorough literature review, the methodology chosen for this research is one that's widely accepted by the finance and academic circles. There were 5 profitability models used to measure the performance of the fund, the first one being the capital asset pricing model, the CAPM for short, the Jensen's measure, as well as the Sharpe and Treynor's ratio, and finally the information ratio. Starting with the CAPM, this is a financial model developed in the 60s that describes the relationship between the systematic risk and the expected return for the stock. The overall idea here is that investors should be compensated for the amount of systematic risk that they're taking, which is measured by the asset beta. This model is also considers the risk-free rate, which is usually represented by the treasury bills of the country, as well as the market's return and the relationship of these elements with the asset beta. This model is also based on several assumptions, the first one being that the investors are rational, they are risk-averse, but they also assess risk all the same way. The market also being competitive without any imperfections, as well as the assets being divisible and tradable without any restriction. Moving on to the Jensen's measure, which is also known as the Jensen's alpha. This is a risk-adjusted performance measure, which compares the average return of the investment to the return predicted by the CAPM. The alpha calculated can be positive, in which case the portfolio has indeed outperformed the market, while a negative Jensen's alpha means that the portfolio has underperformed. The Sharpe ratio is another widely known financial metric, which is still used to this day, and it measures the difference of the realized returns of the investment and the risk-free rate in relationship with the standard deviation of the investment return. The resulting figure represents the additional amount of return an investor receives relative to the amount of risk taken, meaning that the higher the Sharpe ratio, the better. And Much like the Sharpe ratio, we have the Treynor ratio, which is another reward to risk measure, as it also compares the excess return with its volatility. But as opposed to the Sharpe ratio, this one considers the systematic risk, which is measured by the asset beta instead of the total risk, which is measured by the standard deviation. And although both measures are important, the Sharpe ratio is usually considered more adequate with poorly diversified portfolios, while the Treynor ratio is more adequate for fully diversified portfolios. Finally, the information ratio also measures an investment return while being risk adjusted, of course, when compared to the benchmark. It is similar to the previous ratios, but it uses the excess return over the benchmark instead of the risk-free rate. And in addition, instead of using the volatility of the asset or its beta like the previous ratios, the information ratio uses the tracking error, which is nothing more than the standard deviation of the excess return over the benchmark, which is the active return. This measure is often used to assess the portfolio manager's skill to outperform the market while being, of course, risk adjusted. Moving on to the data chosen, this analysis was based on 4 equity mutual funds, mainly or completely invested in the Portuguese market. The criteria here was to find the largest Portuguese equity-focused fund. As for the risk-free rate, I have used the 10-year Treasury bond yield, and as for the benchmark, I've used the PSI Geral index. The reasoning behind using the PSI Geral over the PSI 20, which is the most popular usually, is due to the fact that the PSI 20 aggregates about 16 companies, whereas the PSI Geral aggregates 37 companies, which already puts it at a more diversified status. And comparing with the funds that at the time held at least 20 positions, it was more adequate to use the PSI index. Additionally, the period considered for this analysis was between November 2019 and April 2023, in order to take into account the fluctuations caused when the pandemic hit, until it was no longer considered a pandemic status by the World Health Organization. The first statistical metrics calculated were the mean, the minimum and the maximum returns, as well as the volatility, the correlation with the benchmark, and the p-value for the mean. At a first glance, neither of the funds had on average a higher return than the benchmark, the closest one being BPI Portugal, which also has the highest minimum return and second highest maximum return. In terms of correlation, GNB had the highest correlation and the lowest volatility, which comes very close to the benchmark volatility. A t-test was also performed to assess the quality of the means between the funds and the benchmark, which for a confidence level of 95%, we can say that the null hypothesis is not rejected, as the p-values are well over 5%, which supports the idea that the funds had similar returns to the benchmark. It is also important to highlight that the least correlated fund is also the fund with the lowest p-value, which is expected, as Caixa Ações Portugal Espanha also invested in Spain, as the name suggests. The KPM parameters were calculated using a simple linear regression, for which the resulting beta values were very close to 1, and these being statistically significant, meaning that the fund's returns are very much linked to the benchmark's return. Beta here differs from the correlation in the sense that it tells us by how much the variable here moves compared to the other, in this case the benchmark. And although none of the alphas calculated are statistically significant, they remain in line with the average return, as they are all negative. Finally, the R squared differs from the correlation, as it represents the proportion of the variance of the fund's return that are explained by the benchmark's return. And as we can see, this also goes in line with the correlation, as the highest correlated fund was also GNB. As for the performance measures, it is apparent that the alpha is in line with the KPM parameters, in the sense that none of the funds were able to deliver above market return, while being, of course, adjusted for market systematic risk. In terms of the Treynor and Sharpe ratio, both offer different views on the amount of excess return that the investor earns per unit of systematic or total risk, respectively. And in this case, all funds performed worse than the benchmark, even though BPI Portugal came very close. The information ratio can be analyzed by itself, but its parameters are also analytically relevant, as the average active return shows us, on average, all funds had negative returns over the benchmark, The tracking error on the other side presents the consistency of this active return. And finally, the information ratio relates both of these measures, which comes out to be logically negative due to the fund's active return being negative as well. Moving on to one of the key elements for the investors when choosing between a passively managed fund versus an actively managed fund, which are, of course, the fees and the costs. These may be direct or indirect, depending on if they are deducted from the investor's returns or from the fund's assets directly. And also, depending on the holding period, there might be a heavy redemption fee associated. But all in all, the most substantial fee is, as one might expect, the management fee, with the rest of the fees varying from fund to fund, of course. Finally, in order to have a point of comparison between two neighboring countries, I have also selected 4 Spanish equity funds and performed the same calculations as for the Portuguese ones, which came out to be quite interesting as they had, in fact, very contrasting scenarios. As we can see, despite all the Spanish funds performing on average worse than the Portuguese ones, they've actually managed to surpass the chosen benchmark for the Spanish market, the IBEX 35, which had on average a negative return. Additionally, all Spanish funds displayed a higher volatility, which will come to play in the performance measures. As we can see, the Portuguese funds having a lower volatility and a higher return results in much higher Treynor and Sharpe ratios compared to the Spanish funds. On the other hand, all Spanish funds had higher returns than the IBEX 35, which resulted in positive alpha all around. The objective of this master thesis was to examine the performance of actively managed funds in comparison to their passive peers in the context of the COVID-19 pandemic, which was an exceptionally volatile environment, as we all know, in times where one might prefer to have a dedicated portfolio manager. Others might migrate in a flight to quality scenario, which clears the path for index funds. Through all the metrics used for this research, we came to understand that the selected Portuguese funds underperformed in relation to the PSA Geral, with BPI Portugal nearly matching the benchmark's performance in several metrics, also having the best risk-to-reward ratio out of the 4 funds. Although, more importantly, this underperformance is aggravated by the weight of the management fees, which are also the lowest for BPI Portugal. Finally, in the interest of comparing the Portuguese and the Spanish market scenario, during this pandemic, it has been verified that the Spanish funds have indeed outperformed its benchmark. But once again, this comes short as the impact of the fees results in a negative net return for the investor. Lastly, and clearing the way for further investigation, another element that is starting to pick up on mutual funds, not only within the financial institutions, but for investors as well, is the ESG commitment for the asset managers. Some articles have surfaced mentioning the positive impact that this might have on fund performance, while others prove to be quite the contrary. So this is also worth exploring in the future. Thank you.